And naturally, another alternative would be the metals, silver and gold, because in a world with negative yields, zero is a high yield asset.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics. Tonight, fun conversation with a good friend of mine, Matt Carr, fund manager, who is also an Austrian economist and a really sharp guy. Although before we dig in, this video is sponsored by Silver Elephant, who you've probably seen on the show before, John Lee, who was also with us at Silverfest. Real quick, they did have some results here. Silver Elephant Mining announces further news, complete assays from the company's first drill program. And we see here 48 meters at 0.42 grams per ton gold, 35.5 grams per ton silver. Link to this release where you can find out more is in the description field below. Take a look at that. We'll have a link to John Lee's interview at the end. And with that said, now it is time for a fund manager's perspective on the silver market. As we roll through Thanksgiving weekend, I'm thankful to have my good friend Matt Carr of QCI Partners making his first appearance on the show. Matt is a fund manager and has his own partnership that he's set up. I met Matt at one of our meetup events back in Denver years ago and was quickly impressed with his knowledge of the markets and overall level of brilliance. So it's a pleasure to have you on in here today, Matt. How are you doing, sir?
I'm doing well. Thank you for having me. I appreciate being here.
Well, it's a pleasure to dig in because I don't know if I would call you a silver or a gold bug. I think you were involved in finance and it was more through your own research that you ended up. What led you towards silver and perhaps even that meeting that day, just so people get an idea of the perspective you're coming from?
Yeah, so at QCI, we manage portfolios for individuals, small businesses, and some charities. And my background was in managing risk, a hedge book for a corporation. So it was foreign exchange risk predominantly and some energy risk. So really, given my background, I was concerned about things like dollar inflation, FX pairs. That's what led me to study more into commodities. And we started QCI in 2012, my partner, Stephen Melanson, and I. So that's ultimately the road that led me to that meetup there, meeting yourself and everyone else.
Yeah, and what would you say, I mean, we'll just get right to it, in terms of a hedge against some of the insane things that are happening in the world, what would you say about silver? Is it a good hedge?
Well, I think the metals are pretty well positioned here for a few reasons, a few things that are kind of unique to the market structure we're seeing. I think the first I would mention is the bond market, because we manage multi-asset class portfolios. So if you look at the bond market, one thing that's very different this go round during this COVID recession is that yields are flat as far as the eye can see. And if you look at like the financial crisis, a year or two after the financial crisis, people were already expecting that we would be seeing 3-4% yields. You'd be getting 4% in your checking account again. That's just simply not the case this go round. So you see 10-year bonds all over the world at zero, some even negative in places like Netherlands and Germany. And it kind of begs the question, is that even an investable asset class? You know, what's a 10-year bond paying zero? It's me giving you a suitcase of cash and you promising to give it back to me in 10 years. I'd rather just have the cash today and do other things. So when I think about people allocating capital, whether it's people investing for their families, their hedge funds, pension funds, their corporate treasuries, I think they're going to increasingly start to ask themselves, is this somewhere that we can even look at as an investable asset? And naturally, another alternative would be the metals, silver and gold, because in a world with negative yields, zero is a high yield asset. So I think that's very constructive for the metals in the medium term.
Yeah, and plus for the long term, now it looks like you could have Janet Yellen running the Treasury. So, I mean, should get along fine with Powell. No arguments there.
You know, that I saw Biden announced Janet Yellen, who is the predecessor to Jerome Powell at the Fed as Fed chair, and she was already kind of greasing the skids. She was out there talking about we should look at the Fed charter and we should broaden it such that they can buy stocks. So you see kind of the dialogue is taking us in a direction that is entirely novel. And, you know, I think probably from a metal standpoint, people worried about inflation, allocating assets. The actions of the Fed were something that were truly profound also. You know, we're throwing around the term trillions now instead of billions. So the scale of it was grand, but it was also the scope that I thought was particularly interesting. They didn't just take us to 0% rates and QE and buy treasuries and mortgage-backed securities. They broadened the asset classes that they were purchasing. They started to provide support to muni bonds. So these are municipalities, states, local governments. And they even started to buy corporate bonds. That was shocking. You know, seemingly that's against the Fed's charter that they're given from Congress, you know, but I mean, that's neither here nor there. But you're already seeing kind of these discussions and undertakings that are broadening the avenues of how they can disperse newly created Fed capital throughout the economy.
Yeah, well, why stop there? But Matt, when it comes to the metals, I don't know, maybe it was a little easier when silver was 17 bucks, close to the cost of production. But when you're looking at portfolios, I mean, we did see a big jump this year. I think there's reasons to suggest that from a long-term perspective, still pretty undervalued, but you're the hedger. So what is what would you say is the downside? Silver 23, 24, 25 bucks for people who are holding silver. What are the risks right now? How low could it go?
Well, you know, it's generally pretty difficult to pick in commodities bottoms. You can manage risk to the downside utilizing options, which is predominantly what we attempt to do for clients in creating return profiles. You know, to manage that downside. I would say on the upside, though, there are structural forces at work with regard to inflation. And you know, inflation is something that's often talked about. You mentioned the Fed's balance sheet. Really, in creating new money in the economy, there are two sources. There's private banks making new loans, which thereby create deposits within the banking system. And then there's the federal government running a deficit, issuing a treasury bond, and the Fed creates bank credit, or I'm sorry, not bank credit, reserves that they purchase treasuries with. So that also increases the monetary base. And, you know, you walk down the list and say you look at the Federal Reserve balance sheet. Year over year, it's up around 80% from 4 trillion to about 7.2 trillion, give or take. So what effect did that have on the monetary base? The monetary base is up about 53% year over year, from 3.25 trillion to around 5 trillion. But then on top of the monetary base, when you include things like people's deposits, time deposits, money market accounts, M2 is what it's actually called, that grew at a lower rate. That's up like 25%, about 15 trillion to 19 trillion. And the reason that you see those rates coming down as you come down that totem pole is because the first source hasn't picked up yet. The banks are not openly, broadly lending. If, as a small business, you try to go to get a bank loan right now, very tough. Credit card debt has actually contracted year over year. So we haven't seen that inflationary impulse yet. What we have seen is an infusion by the Fed and the government to run tremendous fiscal deficits. And that looks to be open-ended because so much of the fiscal deficit is structural now. If you look at like October, you know, they brought in the two largest sources of federal revenue are federal income tax and FICA taxes, Social Security. It was brought in about $200 billion in October. That $200 billion went right out the door for Medicaid, Medicare, and Social Security. So a lot of the government federal level expenditures are already spoken for by programs that are on autopilot. And there currently isn't a discussion to dial those back on either side of the aisle. So it's something that you somewhat comfortably can look forward and say, this is going to continue to grow. In my mind, the question is, what does bank lending look like? Do we catalyze that? Do we see a resurgence in actual private bank lending? If so, that will expedite the inflation numbers that you see.
Yeah, that makes a lot of sense. I also appreciate you mentioned how you can hedge a lot of these things out with options. I mentioned on the show quite a bit that I used to be an option market maker. And you and I actually have talked quite a bit about different projects regarding options. So for folks who are looking for help with options, Matt, hopefully you'll let us know how they can contact you before we wrap up at the end. Matt, one thing I think would be fun to track, are you familiar that often there's a school of thought that prior to the option expiration, apparently the banks are just basically selling vol left and right, and they rig the price to the strike, so they really just screw their customers. Any thoughts on that? I know we've talked a little bit about it, but as an option expert, anything you could comment there?
I think from the standpoint of being a portfolio manager, managing people's money, there are certain pitfalls that you want to avoid. And the situation that you're describing there was abuse by certain actors hammering down the spot price such that their options actually made them an outsized amount of money. And we've seen this in a lot of markets that have been manipulated. LIBOR, of course, was everywhere in the news. I think looking forward over contracts, depending on what you're dealing in, you know, futures, options on futures, options in general, you just want to keep in mind that liquidity is always important. You want to be able to get in and get out. And depending on your size, how many, what your funds that you're actually managing are, you have to pay attention to that. So avoiding illiquidity is very important.
Yeah, in fact, we saw something like that happen this week. Matt, did you happen to catch the spike in cocoa prices? It looks like Hershey took delivery. Are you familiar with this, and any thoughts on what happened in the cocoa futures?
Yeah, I read about it. We did not in any way have any exposure to cocoa futures. It's an interesting market. It's one of the more interesting soft markets. You have tremendous production that's concentrated out of the Ivory Coast. So there's geographic risk there. There's also tremendous weather risk. And yet the demand for chocolate bars is pretty level. So it's an interesting market. I saw Hershey really was effectively almost cornering the market.
Yeah. Maybe it's Santa Claus.
Yeah, I mean, and sometimes we see this. I remember, Mr. Copper was a guy out of Japan that was cornering the copper market. There was a fund, this was maybe 20 years ago, that also was taking tremendous delivery of cocoa futures. So, shades of the past to a certain degree. Not quite Hunt Brothers level, though.
Matt, another market that keep an eye on here. I keep things silver focused, yet I'm curious from your perspective that we see Bitcoin was above $19,000 earlier this week. Is the crypto market telling us something? Is it just wild speculation? I don't know. Could it be a canary in the coal mine that we'll see the crypto market explode before the metals explode? Is there any correlation, or what do you think about that?
I think it's a fascinating market. It's definitely something that has benefited from inflationary concerns given the stimulus. What we really focus on within crypto is the options market, which is somewhat nascent, but there it's quite unique because the preponderance of exposure to Bitcoin is long only. And it's not necessarily easy to borrow and short Bitcoin. So the way that the skew of the options lie, and that just means the differential between calls and puts, is quite unique in the Bitcoin market. That's something that we do operate within. We have a strategy around that we manage for accredited investors. And, I think it's driven by the unique characteristics of the participants in that market. The fact that there's very little, if any, institutional involvement, and the fact that shorting, other than swaps or futures, is very difficult at this point. So it's an interesting place. It's nascent, but it's dynamic. And there's definitely opportunity there.
Yeah, I think so. And Matt, last question for you today. Again, as someone who runs a fund, how do you think it's going to go with these silver stocks? I've talked quite a bit on the show this year. First Majestic is trading lower than when silver was $18 before the move. A bunch of other stocks that's similar, or if not the same case. Is it a matter of at some point it's going to become the trendy thing to do once price goes through some moving average? How do you see that playing out with money coming into the mining stocks, where especially in silver, it's a very small market that cannot really handle sizable inflows?
I think that's key. I mean, it's pretty broadly understood that the industry in general is attractively valued at this point. It's very cheap. And silver itself has exhibited great volatility. So options there have been very interesting. But with regard to the miners themselves, we're very constructive on return profiles through options going out a year or so that are to the upside with some gearing, because valuation isn't something that in any way we would use for timing, but having that exposure has actually gotten cheaper because of the phenomenon you just mentioned. The miners have underperformed the underlying metal. So we're actually putting on positions that would benefit from a normalization or reversion of that through the next calendar year at least.
Yeah, well, it's going to be an interesting one. We'll see what happens. I don't know, maybe they'll stretch it out longer. Again, that's one thing I'm fortunate for is this Thanksgiving season is that, especially with the options, you can hedge a lot of these things out, a lot of different creative ways to go. That's what I loved about option trading, where you can really be specific in an opinion you want to express. And Matt, can you let folks know how they can find you? And are we up and ready to go compliance-wise? If there are people, I've had many inquiries about option strategies. Are we set up and ready to do that if people are interested?
Yeah, absolutely. They can find us at QCIPartners.com or email info@QCIPartners.com. There you go. That's it.
Well, I appreciate that, Matt. You're one of the smartest people I've met since I've started doing this. It's been a lot of fun getting to know you as a friend, but also having our conversations. And again, with the options thing, I've thought over the years of whether it was a fund that I wanted to do or somewhere that I could just provide insight and what I've learned throughout my time, combine that with someone like yourself who has the infrastructure set up, as well as your own knowledge base, which is incredible. So info at QCI Partners, and can check in with Matt. So Matt, thank you again for joining me. We'll have to do this again soon.
Thank you. I really appreciate it.
All right, folks. And once again, tonight's episode sponsored by Silver Elephant, where John Lee is running the show. And to find out a little bit more about John and what he's been up to, well, that interview is coming your way now.